Stochastic indicators are momentum oscillators used in technical analysis to identify potential reversal points in price movements. Developed by George Lane in the 1950s, these indicators compare a security's closing price to its price range over a specific time period. The stochastic oscillator is displayed as a line typically ranging from 0 to 100, with readings above 80 considered overbought and below 20 considered oversold. The core concept behind stochastic indicators is that in uptrends, prices tend to close near their highs, while in downtrends, they close near their lows. Stochastics help traders determine when a security might be overbought or oversold, potentially signaling a price reversal. The stochastic oscillator consists of two lines, cent K, which is the fast line, and cent D, which is the slow line. These two components work together to measure momentum and identify potential reversal points in price action. Cent K is calculated using the formula 100 multiplied by the current closing price minus the lowest low divided by the highest high minus the lowest low. The lowest low and highest high are typically calculated over a 14-period window, though this can be adjusted. Let's work through an example calculation. Say we have a current closing price of $50 with a 14-period lowest low of $45 and a highest high of $55. Plugging these values into our formula, cent K equals 100 times 50 minus 45 divided by 55 minus 45. That's 100 times 5 divided by 10, which equals 100 times 0.5, giving us a cent K value of 50. This result of 50 indicates that the current price is exactly in the middle of the 14-period range. The cent D line is typically calculated as a 3-period simple moving average of the cent K line. For example, if we have cent K values of 45, 50, and 55 for 3 consecutive days, cent D would be the average, which is 50. The stochastic oscillator moves between 0 and 100. Typically, values above 80 are considered overbought, while values below 20 are considered oversold. Here's a visualization of how cent K and cent D lines might move together. Cent K is the fast line shown in gold, while cent D is the slower-moving white line that smooths out some of the volatility in cent K. When these lines enter the overbought zone above 80, it may indicate a potential bearish reversal. Conversely, when they enter the oversold zone below 20, it may signal a potential bullish reversal. To summarize the mathematics behind stochastics, cent K measures where the current price sits within its recent range, cent D smooths out cent K for a clearer signal, and together they create an oscillator that helps quantify momentum and identify potential reversal points. Let's compare fast and slow stochastic indicators and understand their key differences. There are two main types of stochastic indicators, fast and slow. The fast stochastic is more sensitive to price changes and can generate more trading signals. However, it also produces more false positives due to its higher responsiveness. The slow stochastic applies additional smoothing to filter out market noise. This makes it more reliable, but potentially less responsive to rapid market changes. Now let's examine the formulas that define both types of stochastic indicators. The fast stochastic consists of the raw cent K line, which measures the current price relative to its range over a period, typically 14 days. The cent D line is a 3-period simple moving average of cent K. The slow stochastic uses the cent D line from the fast stochastic as its cent K line. It then calculates a new cent D line as a 3-period simple moving average of this new cent K. This creates an additional layer of smoothing. Let's visualize how both indicators appear on the same price data. Note the overbought zone above 80 and oversold zone below 20. The fast stochastic, shown in red, is more responsive to price changes but generates more false signals. Notice how it moves into the overbought and oversold zones more frequently. The slow stochastic, shown in green, is smoother due to additional averaging. It stays within reasonable ranges more often, generating fewer but potentially more reliable signals. Here we can see how the fast stochastic generates potential false signals by quickly moving into overbought and oversold territories, while the slow stochastic stays within more moderate ranges. To summarize, the fast stochastic consists of the raw cent K line and the cent D line, which is a 3-period SMA of cent K. The slow stochastic uses the fast cent D as its cent K line, then calculates a new cent D. This additional smoothing makes it more reliable but less responsive to rapid market changes. The choice between fast and slow stochastic depends on your trading style and the current market conditions. Stochastic oscillators are powerful tools for identifying overbought and oversold market conditions. The stochastic oscillator uses a scale from 0 to 100, with key threshold levels at 80 and 20. The oscillator consists of two lines, the faster K line shown in gold and the slower cent D line shown in white. When the stochastic lines rise above 80, the security is considered overbought, suggesting a potential downward reversal. Conversely, when the lines fall below 20, the security is considered oversold, indicating a possible upward reversal. However, during strong market trends, securities can remain in overbought or oversold territory for extended periods. This is why successful traders seek confirmation before making decisions. Using additional indicators, price action signals, and understanding the broader market context can improve accuracy. By properly interpreting overbought and oversold conditions while being mindful of their limitations, traders can better identify potential entry and exit points. Stochastic divergence signals are powerful indicators of potential market reversals. Divergence occurs when price movement and the stochastic oscillator move in opposite directions, signaling a weakening trend that may soon reverse. To understand divergence, we need to examine both price movements and stochastic indicator patterns. The stochastic oscillator typically ranges between 0 and 100, with values above 80 considered overbought and below 20 considered oversold. Let's first examine bullish divergence. Bullish divergence occurs when price makes a lower low, but the stochastic oscillator makes a higher low. Here we can see the price making a lower low, while the stochastic is making a higher low in the oversold region. This divergence suggests underlying buying pressure despite falling prices, often leading to a bullish reversal, as we can see here. Now let's examine bearish divergence. Bearish divergence occurs when price makes a higher high, but the stochastic oscillator makes a lower high. Here we can see the price making a higher high, while the stochastic is making a lower high in the overbought region. This divergence suggests underlying selling pressure despite rising prices, often leading to a bearish reversal, as shown by the subsequent price decline. Divergences are considered strong reversal signals, especially when they occur in overbought or oversold territories. Bullish divergence is most effective when the stochastic is in the oversold region below 20. And bearish divergence is most powerful when the stochastic is in the overbought region above 80. Always confirm divergence signals with additional indicators or price action before making trading decisions. The full stochastic indicator builds upon the standard stochastic by adding a third parameter, giving traders more control over sensitivity. It's expressed as stochastic NMP, where each parameter serves a specific purpose in the calculation. The N parameter represents the look-back period for cent K, determining how many price bars are considered in the calculation. The M parameter applies smoothing to cent K, creating a less volatile signal by averaging the raw cent K values. The P parameter determines the smoothing period for cent D, which is a moving average of the smooth cent K line. Let's examine a common example setting of 1433, which many traders use as a default configuration for the full stochastic. In this 1433 setup, cent K uses a 14-period lookback with 3-period smoothing, while cent D is calculated as a 3-period SMA of the smooth cent K. The power of the full stochastic lies in its customization options. By adjusting these three parameters, traders can fine-tune the indicator to different market conditions and trading styles. Shorter look-back periods increase sensitivity and generate more signals, while longer periods provide a smoother indicator with fewer false signals. Similarly, adjusting the smoothing parameters affects how quickly the indicator responds to price changes. Common settings include 533 for faster signals, 1433 as a standard configuration, and 2177 for a slower, smoother response that minimizes false signals. Stochastic indicators work best when combined with other technical analysis tools. Trend indicators like moving averages can confirm the overall market direction, while stochastics identify potential entry and exit points within that trend. The stochastic oscillator identifies potential entry points when coming out of oversold territory and exit points when falling from overbought territory. Volume indicators can validate stochastic signals by confirming that price movements are supported by significant trading activity. Support and resistance levels can provide additional context for stochastic signals, making them more reliable when they occur near key price levels. This multi-indicator approach helps reduce false signals and improve trading outcomes by providing confirmation across different analytical methods. Stochastic indicators perform differently across various market conditions. Understanding these differences is crucial for effective application. We'll examine how stochastics behave in three primary market conditions: ranging markets, trending markets, and volatile markets. In ranging markets, prices move sideways between support and resistance levels. This is where stochastic indicators excel. When price oscillates between support and resistance, stochastics generate reliable signals. Buy when the indicator moves below 20 and back up, and sell when it rises above 80 and turns down again. In trending markets, price shows a consistent direction, either up or down. Here, using stochastics requires a different approach. In an uptrend, use stochastic oversold readings to identify pullbacks as potential entry points. Avoid selling just because the indicator reaches the overbought zone, as this is normal in strong trends. Volatile markets present the biggest challenge for stochastic indicators. Rapid price movements can generate many false signals. To combat false signals in volatile conditions, adjust the parameters by extending the look-back period or using the slow stochastic instead of fast. To effectively apply stochastics across different market conditions, remember these key principles. First, identify the market condition. Then adjust your interpretation accordingly. Use longer parameters for volatile markets, combine with trend analysis, and never trade against the dominant trend.